My Coinbase Advanced Trade Setup, how I organize portfolios and execute faster. $374. That's what you pay in fees on a single $10,000 trade using Coinbase's default simple interface. Switch to Advanced Trade on the exact same account, and that number drops to $60. Same platform, same login, same assets, just a different tab. And most people using Coinbase right now have no idea that tab even exists. If you've been on Coinbase's simple interface, you're not doing anything wrong. That's what they show you by default. But you are overpaying, probably by a significant margin. Today I'm going to show you how to switch, how to use the order types that give you real control over your entries and exits, and how I organize portfolios to keep strategies from bleeding into each other. Let's get into it. Let's make the fee math clear, because this is the thing that should grab your attention. Coinbase Simple charges up to 3.74% per trade. That's their retail rate, and it applies to most people on the default interface. Coinbase Advanced Trade, at the base tier, Advance 1, which covers under $10,000 in 30-day volume, charges 0.60% on taker orders and 0.40% on maker orders. We'll get to maker and taker in a moment. But here's what that gap looks like in actual dollars. On a $100 trade, Simple costs $3.74. Advanced costs 60 cents. On a $1,000 trade, that's $37.40 versus $6. On a $10,000 trade, it's $374 versus $60. $314 left on the table on a single trade. Work out what that adds up to if you're trading multiple times a week. It's not a rounding error. It's real money leaving before the market even has a chance to move against you. The tier structure gets better as volume goes up. Cross $10,000 in 30-day volume and you drop to 0.25% maker and 0.40% taker. At 50,000, it's 0.15% maker and 0.25% taker. At 500,000, you're at 0.10% and 0.20%. The more you trade, the lower your per trade cost. Compare that to Simple, where the rate never drops no matter what. How do you switch? On the web, go to coinbase.com/advancedtrade. In the app, tap the Trade tab and look for the Simple to Advanced toggle at the top. That's it. No subscription, no upgrade. It's a free feature inside your existing account that most people never touch. Now, maker versus taker. This distinction matters, and it comes up constantly. A taker order executes immediately against an existing order on the book. You're removing liquidity. Market orders are always taker orders. The exchange charges more for this. That's the taker fee. A maker order doesn't execute immediately. It sits on the book and waits. You're adding liquidity. Limit orders that don't fill right away are maker orders, and the exchange rewards you with lower fees. This is the main reason experienced traders default to limits. You get better price control and a lower fee tier at the same time. Let's walk through the 4 order types in Advanced Trade and when you'd actually use each one.
Market orders are the simplest. You hit buy or sell, the order fills immediately at the current market price. The use case is urgency. You need out fast, the market is moving hard against you, and price precision doesn't matter. The trade-off is you're always a taker at the highest fee rate, and in thin or fast markets, you can get slippage, filling at a worse price than expected because there wasn't enough liquidity at the quoted level. Limit orders are what you want to use for the vast majority of your entries and most of your planned exits. You specify the exact price you're willing to buy or sell at, and the order only fills at that level or better. It sits on the book until it either fills or you cancel it. The practical tip here is to use the post-only option when placing limit orders. Post-only guarantees your order will only execute as a maker. If it would fill immediately as a taker, the system cancels it instead of executing it. This gives you the guaranteed lower fee tier on every entry. If you're patient enough to set a price and wait, post-only is the way to go. Stop limit orders are 2-part orders, and they're what you use for automated risk management. There's a trigger price, called the stop, and an execution price, the limit. When the market hits your trigger, the limit order activates and goes to the book. Here's a practical example. Say you're holding BTC with an average entry around 118,000. You want to protect yourself if the market turns hard. You set a stop at 105,000 as your trigger and the limit at 103,000 as your execution price. If BTC drops to 105, Your limit order to sell at 103 or better automatically hits the book. You don't have to be watching the screen. It handles the exit for you. The gap between the stop and the limit, that $2,000 buffer in this example, accounts for the fact that in a fast-moving market, you might not get filled at exactly your stop price. The limit gives you control over the worst price you'll accept. Bracket orders are the most advanced option, and honestly the one that makes me sleep better at night on leveraged positions. A bracket order lets you set a profit target and a stop loss simultaneously when you enter a position. You enter the trade, and both your exit orders are already live on the book. If price hits your target, you take profit automatically. If price goes against you and hits your stop, you exit automatically. This is genuinely fire-and-forget risk management. I use bracket orders on every leveraged position I take. You define your risk before you enter, the system enforces it, and you remove the emotional decision-making from the exit entirely. Now let's talk about portfolio organization, because this is the piece that I don't see discussed enough, and it's had a bigger impact on how I trade than any indicator setup. Coinbase Advance supports up to 100 separate portfolios under a single account. Each portfolio is isolated, separate balance, separate order history, separate API key. Transfers between your own portfolios are instant and free. Here's how I structure mine and why. Portfolio 1 is my BTC core hold.
This is long-term conviction capital. I do not trade from this portfolio. There are no open orders, no stop losses, no limit sells. The BTC in here has one job: sit there. Keeping it in a dedicated portfolio means I never accidentally sell it in a moment of panic or misclick it when I'm executing a trade in a different strategy. Portfolio 2 is my active trading portfolio. This is where I trade ETH, SOL, and select alts on shorter time frames. When I have an active thesis that I'm playing on a 1 to 14-day horizon, this is where it lives. The P&L on this portfolio reflects only those trades, which makes it much easier to evaluate whether my active trading is actually adding value or just creating noise. Portfolio 3 is my DCA accumulation portfolio. This is bot-fed. My Python bots connect to this portfolio via its dedicated API key and execute scheduled buys on a cadence. If you've watched any of the earlier CipherEdge videos on building Python trading bots, the API key setup here is exactly what those bots use to interact with Coinbase programmatically. Each portfolio gets its own key, so your DCA bot has no access to your active trading stack or your core hold. You limit the blast radius if anything goes wrong. Portfolio 4 is speculative small caps. This is where I size into higher risk, lower liquidity positions. Positions in here might go to zero. That's a real possibility I've accepted going in. Because this capital is completely separated, a bad outcome in Portfolio 4 doesn't touch my BTC hold, doesn't affect my active trading, and doesn't contaminate my DCA. That last point is the real value of portfolio segregation. When everything is in one bucket, a bad speculative position creates psychological pressure across your entire account. You start second-guessing your BTC hold because the overall number looks bad, even though the speculative loss is the only real problem. When strategies are isolated, a loss in Portfolio 4 doesn't contaminate how you feel about or react to Portfolios 1, 2, or 3. Now, a quick word on the charting setup, and I'll keep this brief because I'm planning a dedicated chart walkthrough video that goes much deeper. Advanced Trade has a solid built-in charting suite. You get EMA, moving averages, MACD, RSI, Bollinger Bands, VWAP. The major indicators are all there. My personal setup uses 3 things: RSI on all time frames set to 14 periods, an EMA 21 and EMA 200 on the price chart for structural trend direction, and MACD for momentum confirmation. RSI gives me a quick overbought and oversold read. Above 70, I tighten stops and reduce position size on new entries. Below 30, I start looking for entry setups. Nothing revolutionary, but consistently applied, it keeps you out of the worst timing mistakes. The EMA 21 and 200 crossover tells me the structural trend direction. When the 21 crosses above the 200, that's a bullish structure. I'm willing to hold longer and size up. When it crosses below, I treat it as a bearish structure and shift to shorter-term setups only. I'm not trying to catch the big down move, I'm just acknowledging the environment has changed.
One layout tip that has genuinely improved my decision-making, I always keep BTC on the 4-hour chart on the left side of my screen, regardless of what I'm trading. If I'm looking at a SOL entry on the right, BTC's 4-hour gives me the macro backdrop. Most alt moves are still highly correlated to BTC in the short term. If BTC is showing weakness on the 4-hour and I'm looking at a SOL long, that context matters. Don't trade alts in a vacuum. Before I wrap up, a few practical execution notes that I think are worth calling out explicitly. Always use limit orders on entries. The only time I use a market order is an emergency exit when I need to be out immediately. For planned entries, set your limit, use post only, and wait. You'll get better fills and lower fees every time. When you're placing limit buys, set your limit slightly below the current ask. You're trying to bid the spread. This gets you maker status rather than taker. It might take a few minutes longer to fill, but you're paying less and getting a better price. Use good till canceled for accumulation zone orders. If you've identified a support level you want to buy, put a GTC limit order there and let it work. You don't have to babysit the screen. The order stays active until it fills, or you manually cancel it. Keep an eye on your Open Orders tab for partial fills. In thinner markets, limit orders sometimes fill in pieces. Part of your order at one price, the rest over the following hours. That's normal, but track it so you know your actual average entry. And use Coinbase's price alerts as a prep signal before your limit zones. Set an alert a few % above your target price so you have time to review the setup before it actually gets there. Last thing, I want to be honest about where Coinbase Advance sits relative to other exchanges. Binance and Bybit have lower fees. That's just true. If you're purely fee optimizing and you're comfortable on those platforms, they're legitimate options. But for US-based traders, Coinbase gives you something those platforms don't. U.S. regulation, strong security track record, native tax forms, specifically the 1099-DA, which makes your crypto tax filing dramatically cleaner, and wide asset selection without the regulatory uncertainty that offshore exchanges carry. For most U.S. traders, that combination is worth the modest premium over the absolute cheapest option globally. Advanced trade fees are competitive. They're not the cheapest in the world, but they're reasonable for what you get. If you're new to Coinbase, there's a referral link in the description. New accounts get $10 in BTC as a sign-up bonus, and there's a 50% fee rebate for the first 3 months, which, given everything we just covered, makes your effective rate even lower right out of the gate. If this was useful, subscribe. I'm building out a full systematic trading series covering Python bots, charting deep dives, and execution frameworks, and you don't want to miss the next one. Drop your questions in the comments. I read them. See you in the next video.